Welcome back to the Crypto Discipline. Today, we're diving into one of the most fascinating concepts in financial markets, the bull and bear cycles. We'll talk about where these terms come from, the history of bull and bear cycles in crypto and traditional markets, and why these cycles always repeat. Plus, I'll share insights on what smart investors do and how to avoid common mistakes. Let's get started. First, let's address the question: why are they called bull and bear cycles? The bull. The term bull comes from how bulls attack. When a bull fights, it charges forward and strikes upward with its horns. This upward motion represents the rising market, optimism, growth, and higher prices. The bear. Bears, on the other hand, swipe down with their claws during an attack. This downward motion symbolizes a falling market, pessimism, fear, and lower prices. These metaphors date back centuries to the stock markets of Europe and the US. They've become universal symbols for describing market conditions. Let's look at some historical bull and bear cycles in both crypto and traditional markets. Traditional markets. Great Depression, 1930s, one of the worst bear cycles in history. Post-World War II boom, 1940s-1960s, a massive bull cycle driven by rebuilding and economic growth. Dot-com bubble, 1990s, a tech-driven bull market that ended with a sharp bear cycle in 2000. Cryptocurrency. Bull season and bear season 2011. Bitcoin's first bull cycle, with prices rising from $1 to $32, followed by a bear cycle back to $2. 2013-2014. Bitcoin surged to $1,200 during a bull cycle before crashing to $200. 2017-2018. The famous bull cycle where Bitcoin reached $20,000 before falling to $3,000 in a bear market. 2020-2021. The most recent bull cycle saw Bitcoin hitting $69,000 before dropping below $20,000 in 2022. These cycles might seem random, but they have a pattern. The repeating nature of these cycles is driven by human psychology and market dynamics, greed and fear. During a bull market, people are optimistic and greedy, driving prices higher. In a bear market, fear takes over, and people sell, causing prices to drop. Economic factors like interest rates, inflation, and macroeconomic trends play a role. Market maturity. In crypto, bull cycles often follow major innovations or adoption milestones, while bear cycles act as periods of correction and consolidation. Let's understand this with a relatable example. Think of seasons. Just like summer follows winter, bull markets often follow bear markets. It's the natural rhythm of the financial world. Let's be real. How you behave during these cycles can make or break your portfolio. Let's see what smart investors do. 1. Buy low, sell high. They use bear markets as opportunities to accumulate assets at lower prices. They sell strategically during bull markets to lock in profits. Stay disciplined. They don't let FOMO or panic dictate their decisions. Let's now see the mistakes dumb investors make. Buy high, sell low. They chase the hype during bull markets, buying at the peak. During bear markets, they panic and sell at a loss. Ignore the cycle. They hold on to assets even when it's clear the market has peaked, missing out on profits. Here's a relatable example. It's like buying a watermelon in peak summer when it's most expensive and selling it in winter when prices are lowest. It's the opposite of what you should do. One of the golden rules of investing is, don't get too greedy. Cycle repetition. Bull markets don't last forever. If you don't sell during the peak, you risk watching your profits vanish during the next bear cycle. As Warren Buffett says, be fearful when others are greedy, and greedy when others are fearful. Another classic is, the stock market is a device for transferring money from the impatient to the patient. Plan your exits. Set clear goals for when you'll take profits. Whether it's a percentage gain or specific price, stick to your plan. 6. Key lessons on bull and bear cycles. Here's what I want you to remember. Markets will always have bull and bear cycles, it's inevitable. Smart investors use bear markets to buy and bull markets to sell. Timing and discipline are everything. Never let emotions drive your decisions, stick to your strategy. Key takeaways: bull cycles are periods of rising prices, while bear cycles are periods of falling prices. The terms come from the way bulls attack upwards and bears swipe downwards. Smart investors buy in bear markets and sell in bull markets, while dumb investors do the opposite. Selling when in profit is crucial because the cycle always repeats. That's it for today's episode of the Crypto Discipline. If you found this video helpful, hit the like button and subscribe for more insights into cryptocurrency and markets. In our next video, we'll dive into how to spot the signs of a bull or bear market and develop strategies to succeed in both. You won't want to miss it. See you next time.